The moment your paycheck hits your bank account, your bank starts making money off it before you even open the app. Within seconds of that direct deposit landing, they're already lending your money to someone else at 5 times the interest rate they'll ever pay you. They're hoping you'll leave it sitting there, slowly losing value to inflation, while they pocket the difference. But what if I told you there are 5 specific assets that sit completely outside their control, assets they'd rather you never learned about? These aren't risky speculation plays or complicated investment strategies. They're wealth protection tools that bankers actively discourage, because once you own them, you don't need the bank anymore. If you're tired of being a profit center for financial institutions that don't have your interests at heart, make sure to subscribe and hit that like button. Here's something most people don't realize about their bank account. That money you see when you log into your app isn't actually sitting in a vault somewhere with your name on it. It's mostly gone. Lent out to other people, invested in securities, used to fund operations you'll never know about. Your bank is only required to keep about 10% of your deposits on hand at any given time. The rest is working for them, not for you. Most people walk through life with complete blind trust in the banking system. They deposit their paychecks, pay their bills, maybe put a little into savings, and assume everything is perfectly safe because there's a building with marble columns and a reassuring logo. They're basically financial sleepwalkers, completely unaware of how the system actually works and what it means for their money. Here's the reality check you probably don't want to hear. Your savings account earning 0.5% interest while the bank charges 7% on car loans and 20% on credit cards isn't an accident. It's the entire business model. Banks make money by paying you almost nothing for the privilege of using your deposits to generate massive returns for themselves. That spread between what they pay you and what they earn is their profit margin, and they want it as wide as possible. Think about FDIC insurance for a second. Most people believe this means their money is completely protected no matter what happens. But here's what the fine print actually says. Coverage maxes out at $250,000 per depositor, per bank. If you have more than that in a single institution and something goes sideways, you're on your own for the excess. And even within that limit, getting your money back during a real banking crisis isn't instant. It takes time, sometimes weeks. The 2013 Cyprus banking crisis showed exactly what can happen when things go wrong. Banks froze accounts overnight. People couldn't access their own money. And when the dust settled, depositors with more than 100,000 euros saw a chunk of their savings simply taken to bail out the banks. It was called a bail-in, which is a polite way of saying the banks used customer deposits to save themselves. This wasn't ancient history in some unstable country. It happened in a developed economy with a modern banking system. Now here's where it gets interesting. Banks actively promote certain financial products while staying completely silent about others. They'll happily sell you CDs with terrible rates, savings accounts that lose purchasing power to inflation, and investment products loaded with fees. But certain assets that actually protect and grow your wealth outside their control. You'll never see those in a glossy bank brochure. The reason is simple. When your money is in assets the bank can't touch, they can't lend it out. They can't charge you fees for managing it. They can't use it as leverage. And most importantly, they can't freeze it if something goes wrong with their institution. If banks truly wanted you to build wealth, they'd tell you about the assets we're going to cover today. But that would mean losing their grip on your money. And that's the last thing any banker wants. The assets I'm about to show you share something in common. They all exist outside the traditional banking system's control. Once you own them, no bank can freeze them, charge you fees for holding them, or use them as leverage for their own profit. And that's exactly why you've probably never heard your banker recommend a single one of them. Most people do exactly what they're told when it comes to money. They open a checking account, maybe a savings account, perhaps a CD if they're feeling adventurous. They buy the investment products their bank offers, pay the fees they're charged, and assume this is just how building wealth works. But successful people do something completely different. They understand that true financial security means having assets that don't depend on any single institution's stability or goodwill. Here's the thing about banker blacklist assets that nobody talks about. They share 5 key characteristics that make them threatening to the traditional banking model. First, they can't be frozen or seized without your physical cooperation. Second, they don't generate fees for financial institutions. Third, they hold or grow value independent of bank interest rates. Fourth, they provide options during financial crises when banks might restrict access. And fifth, they give you leverage and independence that shifts the power dynamic entirely. The psychology here is fascinating. Banks spend enormous amounts of money convincing you that anything outside their system is risky, complicated, or somehow irresponsible. They want you to believe that the safest place for your money is with them, earning almost nothing while they use it to generate substantial returns for themselves. They frame alternatives as speculation or fringe behavior reserved for doomsday preppers. But here's the reality check. The truly risky move is putting 100% of your financial life inside a system that has failed repeatedly throughout history. Bank runs, bail-ins, account freezes, and institutional collapses aren't ancient history. They happen in modern, developed economies with sophisticated banking systems. Having all your wealth inside that system is like keeping all your eggs in one basket, and then handing that basket to someone else to carry. Think about it this way. If you make $75,000 a year, and you keep everything in bank accounts and bank-recommended products, you're essentially an unpaid employee of the banking system. Your deposits fund their loans. Your fees fund their operations. Your financial stability depends entirely on their continued good behavior. But if you redirect even 20% of your wealth into assets they can't touch, you've fundamentally changed that relationship. You become a customer with options, not a dependent without alternatives. The 5 assets we're going to cover span different categories: tangible, digital, and paper-based. Together, they create a diversified foundation that doesn't depend on any bank's solvency or any government's monetary policy decisions. Let's start with the first asset on the banker blacklist, and it's probably not what you'd expect. Asset number 1 has been a store of value for over 5,000 years, long before banks even existed. Gold and silver have outlasted every currency, every empire, and every financial system humanity has ever created. And here's why your banker will never recommend them. They can't make a single dime off you holding physical metal in your possession. The key word there is physical. Banks actually love selling you paper gold through ETFs and certificates because they still control it, still charge fees, and still use your investment as leverage. But actual gold and silver coins or bars that you hold in your hand, that's a completely different story. Once you own physical precious metals, there's no counterparty risk. No bank can freeze your gold. No government can print more of it. No financial institution can use it as collateral for their own trades. Here's something most people don't understand about how banks sell gold products. There's a crucial difference between allocated and unallocated gold. When you buy unallocated gold through a bank, you don't actually own specific bars with serial numbers. You own a claim against the bank's general gold holdings, which means if the bank fails, you're just another creditor standing in line. Allocated gold means specific bars assigned to you, but even then, you're trusting the institution to actually have what they say they have. The only way to completely remove counterparty risk is to hold physical metal yourself. 1-ounce gold coins, silver bars, bullion you can actually touch. This might sound old-fashioned in a digital age, but that's exactly why it works as a banking system hedge. Let me give you a real example of why this matters. During the Cyprus banking crisis in 2013, people with bank deposits over €100,000 lost a significant portion of their savings to bail-in conversions. The banks literally took customer money to save themselves. But people who held physical gold and silver, their wealth was completely untouched. They didn't lose a single ounce because their assets existed outside the banking system entirely. Now, I'm not suggesting you convert your entire savings to gold bars and bury them in the backyard. The smart approach is allocation. Most financial experts who actually understand wealth preservation recommend holding somewhere between 5% and 15% of your portfolio in physical precious metals. This isn't about getting rich. It's about insurance. It's about having a portion of your wealth that remains stable and accessible regardless of what happens to banks, currencies, or financial markets. Here's how to actually buy without getting ripped off. Stick to reputable dealers with long track records. Avoid collectible or numismatic coins because you'll pay huge premiums for supposed rarity. Buy bullion, plain gold and silver coins valued purely for their metal content. Store them in a quality home safe or private vault, not a bank's safe deposit box where access might be restricted during a crisis. But physical metals are just the beginning. The second asset on the blacklist is something banks are actively trying to suppress. Asset number 2 didn't even exist 20 years ago, and major bank CEOs have spent the last decade calling it everything from a fraud to a threat to the entire financial system. Jamie Dimon of JP Morgan Chase famously called Bitcoin a fraud that would eventually blow up. Warren Buffett called it rat poison squared. And here's what's fascinating about those statements. They tell you everything you need to know about why cryptocurrency belongs on the banker blacklist. When the most powerful people in traditional finance go out of their way to trash an asset class, you have to ask yourself why. The answer is simple. Bitcoin and other major cryptocurrencies represent a financial system that doesn't need banks. No intermediaries, no fees going to institutions, no centralized control over who can send money to whom. For banks, that's not just competition. That's an existential threat to their entire business model. Here's the thing about cryptocurrency that nobody in banking wants you to understand. The blockchain is essentially a public ledger that records every transaction without requiring any bank to verify or process it. When you send Bitcoin to someone, you're not asking permission from a financial institution. You're not paying a wire transfer fee. You're not waiting 3 to 5 business days. The transaction happens directly between 2 parties, verified by the network itself. Now, I need to be honest about something. Cryptocurrency is volatile. The price swings can be dramatic, and anyone who tells you it's a guaranteed path to wealth is selling you something. But here's the reality check most people miss. Volatility and risk aren't the same thing. Your bank savings account has almost zero volatility, but it's guaranteed to lose purchasing power to inflation every single year. A portion of your wealth in crypto might fluctuate short-term, but over the past decade, Bitcoin has outperformed virtually every other asset class by a massive margin. Here's something that might shock you about those same bank CEOs who publicly trash cryptocurrency. Their banks are now quietly building crypto custody services, trading desks, and blockchain infrastructure. JP Morgan, the same bank whose CEO called Bitcoin a fraud, now offers crypto products to wealthy clients. The same institutions telling retail investors to stay away are positioning themselves to profit from the very thing they claim is worthless. The key to holding crypto as a blacklist asset is understanding self-custody. When you buy cryptocurrency on an exchange and leave it there, you don't actually control it. The exchange does. If that exchange fails or gets hacked, your crypto might be gone. The phrase is simple. Not your keys, not your coins. Self-custody means moving your cryptocurrency to a hardware wallet that only you control, completely disconnected from any financial institution. For most people, a reasonable allocation is somewhere between 5% and 10% of your portfolio. Buy through a reputable exchange, then immediately transfer to a hardware wallet. Think long-term, not day trading. Now we get to the 3 assets that really make bankers nervous. Asset number 3 is something banks will actually help you buy, but not for the reasons you think. Real estate, specifically income-producing rental property, sits in a strange position on the banker blacklist. Banks love giving you a mortgage because they make money from the interest payments. But the asset itself, once you own it, works directly against their model of keeping you financially dependent. Here's the twist most people miss entirely. When you own a rental property that generates monthly income, that cash flows doesn't depend on any bank's interest rates, any institution's stability, or any financial product's performance. Tenants pay rent whether the stock market crashes or banks fail. That income stream exists completely independent of the traditional financial system. And once the mortgage is paid off, you own a physical asset that produces money without any bank involvement whatsoever. Let me give you a real example of how this math actually works. Imagine a rental property worth $200,000. With a standard 20% down payment, you'd put in $40,000 of your own money. The remaining $160,000 comes from a mortgage. If that property rents for $1,800 per month and your mortgage, taxes, insurance, and maintenance cost $400, you're cash flowing $400 monthly from day one. Your tenant is essentially paying off your mortgage while you build equity in a real asset. Here's what makes this even more powerful over time. In 10 years, assuming modest 3% annual appreciation, that $200,000 property is worth around $269,000. Your tenant has paid down a significant chunk of your mortgage principal, and you've collected roughly $48,000 in cash flow along the way. Your original $40,000 investment has multiplied several times over, all while existing as a physical asset no bank can freeze or devalue through monetary policy. The key distinction here is buying for cash flow, not speculation. Most people think about real estate as buying a house, hoping it appreciates, and selling for profit. That's speculation, and it's risky. Cash flow investing is different. You buy properties that generate positive income from day one. The appreciation is a bonus, not the strategy. There's something almost ironic about using bank financing to acquire assets that ultimately free you from bank dependence. You're leveraging their system to build wealth outside their control. The mortgage creates the initial relationship, but the rental income and property ownership create independence. Once that property is paid off, the bank has zero involvement in an asset that continues generating income indefinitely. Now, real estate requires more active involvement than gold or crypto. You need to understand your local market, manage tenants or hire a property manager, and handle maintenance. But that hands-on nature is also what makes it resistant to systematic risks that affect purely financial assets. A rental property doesn't care about stock market crashes. People still need places to live. Asset number 4 is even more under the radar. Most people have never even heard of it. Asset number 4 is something the government offers directly to citizens, and banks absolutely hate that you can skip them entirely to get it. I-bonds, or Series 1 savings bonds, are inflation-protected securities you buy straight from the U.S. Treasury without any bank involvement whatsoever. No fees, no middleman, no financial institution taking a cut. You go to treasurydirect.gov, set up an account, and purchase bonds directly from the government. Here's something that might blow your mind about I-bonds. During periods of high inflation, they've offered returns of 7%, 8%, even over 9% annually. Meanwhile, your bank savings account was probably paying you 0.5% while inflation ate away at your purchasing power. The difference between what I-bonds pay and what banks offer on savings is staggering, and banks are counting on you never discovering this option exists. The way I-bonds work is elegantly simple. They have two components, a fixed rate that stays the same for the life of the bond, and an inflation rate that adjusts every 6 months based on the Consumer Price Index. When inflation rises, your I-bond return rises with it. Your money is literally protected against the exact force that makes bank savings accounts worthless over time. There are limitations you should know about. You can only purchase $10,000 worth of I-bonds per person per year through Treasury Direct. You have to hold them for at least 1 year, and if you cash out before 5 years, you lose the last 3 months of interest. But here's the thing, these limitations actually make them better as a long-term wealth preservation tool. The tax advantages are significant too. You don't pay state or local taxes on I-bond interest, ever. And you can defer federal taxes until you cash out, which could be up to 30 years later. For people in high-tax states, this makes I-bonds even more attractive compared to bank savings where you pay taxes on that pathetic interest every single year. Why don't banks tell you about this? Because they can't profit from it. When you buy I-bonds, no bank gets a fee. No financial advisor gets a commission. The government just pays you directly. The fifth and final asset on the banker blacklist is so simple it's almost embarrassing. Physical cash. Actual paper money held outside the banking system. Spoiler alert, banks are actively working to eliminate cash because it represents freedom they can't control. Every transaction made in cash is a transaction they can't track, can't charge fees on, and can't freeze. The push toward digital payments isn't about convenience, it's about control. Keep 1 to 3 months of essential expenses in physical cash, stored securely at home, not in a bank-safe deposit box. During a crisis, you might not be able to access that box when you need it most. Together, these 5 assets create true financial independence. Now here's where most people completely mess this up. Knowing about these 5 assets is completely worthless if you never actually acquire them. Most people hear information like this, feel motivated for about 15 minutes, and then do absolutely nothing. They go back to their regular financial habits, keep all their money in bank accounts, and wonder 3 years later why nothing has changed. The gap between knowing and doing is where financial dreams go to die. Here's the first mistake people make when they learn about banker blacklist assets. They try to buy all 5 at once. They get excited, calculate how much they'd need to allocate to each category, realize they don't have $50,000 sitting around, and give up before they start. Overwhelm leads to paralysis, and paralysis means you stay exactly where you are, completely dependent on the banking system. The second mistake is getting the order of operations wrong. People hear about Bitcoin's massive returns and want to jump straight into crypto speculation without building any foundation first. They skip the boring stuff like emergency cash and I-bonds because it's not exciting. Then they panic when crypto drops 30% in a week because they don't have the financial stability to weather volatility. The third mistake is buying these assets through bank-controlled vehicles. People hear about gold and buy a gold ETF through their brokerage account. They hear about real estate and buy a REIT instead of actual property. They think they're diversifying outside the banking system, but they're still completely dependent on financial institutions to access their own wealth. Here's the correct sequence that actually works. Start with physical cash. Build up 1 to 3 months of expenses in actual currency you can access immediately. This costs nothing except discipline, and it gives you an immediate safety net outside the banking system. Next, start buying I-bonds. Set up a Treasury Direct account and purchase whatever you can afford, even if it's just a few $100s. The $10,000 annual limit means you build this position over time. Then add precious metals. Start with silver if gold feels too expensive. Even $50 per month into physical bullion adds up. A single 1-ounce silver coin costs around $30. But owning it means you have wealth outside any institution's control. After you've built these foundations, then allocate to crypto and consider real estate. Here's how I personally handle the allocation question when starting from scratch. If someone has $5,000 to begin diversifying, I'd suggest roughly $2,000 in physical cash, $1,500 into I-bonds, $1,000 into physical silver, and $500 into Bitcoin on a hardware wallet. That's not perfect, but it gets you started across multiple asset classes immediately. The key is starting small and building consistently. Even $100 per month split across these assets puts you ahead of people who know everything but do nothing. In 5 years, consistent small allocations compound into meaningful positions. The final step ties everything together. The final step is automation, and here's the thing nobody wants to admit. It's not optional. Willpower is completely unreliable. You might wake up Monday morning feeling motivated to build wealth outside the banking system, but by Friday evening when you're tired and stressed, that motivation has completely evaporated. You'll look at your bank account and think you'll start next month when things calm down. Spoiler alert, things never calm down, and next month you'll have even less motivation than you do right now. This is why automation is absolutely critical. When your money moves automatically according to your plan, you remove human emotion and laziness from the equation entirely. Your wealth building happens whether you're having a good day or a terrible day, whether you're motivated or completely burned out. Here's exactly how to set this up. When your paycheck hits your checking account, let it sit for 1 day to make sure everything clears properly. Then, on the day after payday, automatic transfers happen like clockwork. A predetermined amount moves to a separate savings account designated specifically for Blacklist asset purchases. From there, the money flows to its intended destinations on a schedule you control. For I-bonds, you'll need to manually log in to Treasury Direct each month because they don't offer automatic purchases. Set a calendar reminder and make it part of your routine. The purchase takes less than 5 minutes. For precious metals, several reputable dealers offer automatic monthly purchase programs where you set an amount and they ship bullion on a schedule. For crypto, most major exchanges allow recurring purchases that automatically transfer to your connected wallet. The beautiful thing about this system is that you never have to think about it. You never have to remember to move money around. You never have to fight the temptation to spend money that should be building your financial independence. It just happens automatically, like your rent payment or your phone bill. But here's where most people mess up automation completely. They set everything up and then forget to adjust when their situation changes. They get a raise at work but keep saving the same dollar amount instead of increasing their allocation. They pay off a debt but forget to redirect that freed up cash toward Blacklist assets. Every time your income increases, your automatic allocations should increase proportionally. Once a quarter, review your overall allocation across all 5 categories. Are you overweight in one area? Has your risk tolerance changed? These check-ins take 30 minutes and ensure your automation still serves your goals. In 5 years, while everyone else is panicking about bank stability and inflation, you'll be sitting on a foundation of assets they can't freeze, can't inflate away, and can't control. You won't be checking your bank balance obsessively because your wealth doesn't live entirely in that system anymore. This isn't rocket science. It's just intentional. Start with your next paycheck, set up the automation, and in 5 years you'll be laughing at how simple it was while everyone else is still wondering where their money went.